Hello, everybody. Hello, and welcome to Private Equity Rundown. I am Bill, the company's expert. Thank you for joining me today. This is the weekly live stream where we talk about private equity and other more high-level business concepts. This is just something I'm doing for the sheer hell of it because I like this stuff and I know a bit more about it than I do other areas of business. So I wanted to just have an outlet for it and see if it connects with a lot of you people out there, because some of the concepts that we cover in private equity are directly related to careers. Knowing some of the stuff can help you in your career, being aware of it, either indirectly and you understand what you're seeing out in the real world, or directly you can actually harness some of these ideas and these concepts to further yourself and prosper. So that's the idea. As always, a special shout out goes out to all my YouTube channel members. Membership has its privileges. Thank you to you guys. You guys are awesome. My Patreons, ditto. My super thanks donors, and to you, my participants, for being here. Thank you for being here. Yes, the title of this episode, this is Private Equity Rundown, episode number 17. And this is called ROI, the one metric that rules them all. Okay, ROI, of course, standing for return on investment. So we're going to talk about that. We're going to talk about the measurement, ROI, how you calculate it, what it is. And it kind of sums up the motivations of private equity in the first place. You understand what they're trying to do because you understand the metric they care about and why they care about it, and you know how to influence it. So that's the idea. Let's get started. One more thing before we start. A couple of things, actually. Number one, check out that course if you want to learn business. You can learn everything that you would normally learn in a 2-year university MBA program. But for amazing bang for the buck, it's much more flexible. There's a link in the description. More about that later. And also, this is an interactive live stream, so I'm going to be sort of talking about ROI and if you're seeing my face, if you've been a subscriber to my channel for any amount of time, you should be able to see a chat box somewhere nearby. You can get into the chat. You could ask me questions, and I'll do my best to answer them for you if I possibly can, keeping in mind that we're talking about private equity and ROI. Okay, let's dive in. So you might have heard of this term, ROI, return on investment. It's a rather informal term, actually. It does have a precise meaning in the world of accounting and finance, where it's got a very strict definition of how you calculate it. But it's also a term that people throw around in an informal kind of sense that refers to a bunch of different abstract things. So we're going to be talking about kind of both of those, right? This would be really better if I had some slides, but the mathematics I'm talking about, the formulas are extremely simple, so hopefully everybody can follow along. What is ROI? What is return on investment? It is a value that's based on a ratio, okay? Two things, this divided by that, and it gives you ROI, okay? So basically, ROI, the calculation is you have the net gain from investment, so how much money you made, divided by the investment, okay, the cost of investment. So let's see if we can maybe do an example to illustrate this. So imagine if you buy a company, just hypothetically, you're a deca-billionaire and you buy a company, okay? I like those kinds of things, fantasies you kind of think about. And you buy a company that costs you $100 million, and so you sell it 5 years later for $300 million. So you bought it for 100 and you sold it for 300, okay? 5 years later, let's say. And what would be the ROI of that investment? So you buy a company, it costs you $100 million, you hold on to it for 5 years, and then you sell it, but the value of it has gone from 100 million to 300 million. That's what you sell it for. So what's the ROI? Well, like we were talking about before, it's that ratio, right? So what was the gain? What was the net gain that you made? Well, if you bought it for 100 and sold it for 300, your net gain is $200 million, right? That's your gain. So it's 200 divided by the value of the investment. Okay, how much did you pay for it? Well, you paid $100 million for it. So it's 200 million divided by the initial amount you paid, 100 million. It gives you the answer 2. Okay, and 2 is the same thing as 200%, as hopefully everybody knows. So your ROI is 200% in that case. Now, it's kind of a very quick and dirty calculation because, if you think about it, you're not taking into account the amount of time that passed between when you bought it and when you sold it, right? Imagine if you bought a company and you did this, like you paid 100 million, you sold it for 300 million, and you made a 200% return on investment. Imagine if you did that in a month, right? That would be certainly a lot better and more serious than if you bought it for the same amount, sold it for the same amount, but it took you 20 years for the value to go from 100 to 300, right? So this calculation completely ignores the time factor. So that's why it's extremely quick and dirty, right? Return on investment. Okay. And the other thing that we're doing here, okay, that a lot of people may not have picked up on, is that you're assuming that you're going to sell the company, right? Now, that's why I chose to talk about a company as opposed to anything else you could buy, right? A company, you can flip it, like you can buy it for one price and sell it for another, just like a lot of other things. But if you wanted to, you could also hold on to it permanently, right? Because it's a thing that exists, you paid for it and you own it, and if left to its own devices, it will give you a steady revenue stream, right? So you don't necessarily have to sell it to make any kind of profit, right? It is generating profit, on a monthly basis or whatever, right? On an ongoing basis. So you could choose to hold on to it. In which case, what would be your return on investment if you bought it for 100 million, but you held on to it, and you haven't sold it yet, right? Now, it's making you money. There's, in accounting terms, there's disbursements, but there isn't actually a sale price, right? Well, that's where we get into some of these other calculations, these other measurements that we're going to cover today, okay? Things like return on assets and things like return on equity, okay? And what I figured I'd do is I was going to start with this and I was going to go on and on and on, but I think it'll probably take us a while just to cover this if some of these concepts are new to people. I'm not entirely sure what crowd I might be talking to here, what audience, if people are beginners or people are really advanced. So yeah, now I got a question here. Bear Razor says, like someone wants a ROI on their friendship. Okay, this is really what I can speak to, because no matter how selfless you may be, you always want friends that provide something for you. Yeah, exactly. But the thing is, if you're worried about friends, then you probably wouldn't worry about ROI, right? Because there's what we're talking about here, and there's things that don't make you go to hell, right? So it's kind of like, a gap. And what you're talking about is on one side, and what I'm talking about is on the other. So that's how I rationalize it anyway. I'm joking, of course, but you got to have fun with this stuff. Okay, so let's talk about these different cases, right? Obviously, if you're buying something and then selling it, okay, there's a buy price and a sale price, right? And the net value is like the difference between them, if it goes up or it goes down, right? If there isn't a sale, then we look at other things. And that's where sometimes the term ROI gets a bit confused, because when you're not actually selling the thing, we have to use different calculations, different metrics. Now, I wrote myself some notes out. I always have a problem reading my own damn notes, like a true professional, right? Okay, so let's see here. So on an ongoing performance measure basis, not as a transactional basis, we're talking about ROA and ROE. So return on assets and return on equity. Let's dive into both of these, and where this is going to lead us is what private equity firms do, why they do it, why they care, and you'll see mathematically what they're trying to do. Okay, so we covered ROI is basically net profit divided by net worth, okay? Like it was that basic idea, okay? Now, let's define net worth as total assets. That's how it's usually done, right? Now, hopefully here everybody knows what an asset is, okay? So if there's a company and the company owns buildings and the company owns equipment and the company has inventory and the company has office space filled with computers and desks and things like this, maybe they own a website, maybe they've paid for a year in advance for utilities, like this. These are the things that the company owns. They're the property of the company, and all of those things, whether it's inventory, buildings, tools, office space, shop space, websites, all of that stuff, they all serve to generate the profit, essentially, of the company, right? They all exist to bring in a revenue. They usually, there's usually expenses, and then you have a profit, right? So that's what I mean when I say assets. They're all the things that belong to the company that are used in the company generating a revenue stream. Okay? So a very popular metric is return on assets, right? So if you have a building and you have tooling, you have some machines in there, maybe a drill press or some tables and chairs, or like you have some computers, right? And a few desks and telephone lines, right? That's what you have. Okay, so those are your assets. And let's say they're worth $100,000. Okay, you have a building and all the stuff in it. That's worth $100,000. That's what, if you sold it today, for the sake of argument, let's say if you sold it today, that's what you could get for it. It's worth that much. Now, these assets, if used properly, can make you money, right? You can employ some people and you can get them to make something, and in the building, they can use the tooling, they can sell it using, the computers and the phones and the desks, right? And you can generate a revenue stream from it, right? A return. So return on assets means that on $100,000 that all this stuff is worth, how much money are you making with those assets, right? Okay, that's what it is. So this is another way of looking at how profitable, in a way, your business is. It's ignoring things like, these assets that you have. Do you own them outright, or did you take out a massive loan from the bank to just buy them, right? So they're financed through debt, or are they financed through equity? It's not considering any of that stuff. It's just saying, look, these assets that you have, what kind of return are you getting on them? Okay, so that's ROA. And the calculation for ROA, let's look at this here. I really should get some slides going. I really should. If I had more time to prepare this, I really would do that. I'm going to do some proper videos in the future, maybe on this stuff, and I'll get proper slides and things. Bear Razor is here again, and Bear Razor says, I know and I wanted it to be funny. The accounting equation, I'm familiar with this. Yeah. Oh, or a truck. I guess that means in the context of assets. Yes, assets are a truck. Or a Lamborghini. Just buy your salespeople a fleet of Lamborghinis, vintage from 1985, where there's no curved glass or curved surface anywhere on the car. It's all flat, straight, like that, with little wings on it, right? With like a V24 or whatever it is, that's how you really make a statement to your customers that, you're hot shit, when you show up in something like that. And that's what being in business is all about, really. Okay, so we're talking about return on assets, everyone's favorite thing, right? Okay, so you can probably guess what the calculation is. It's another ratio. It's one number divided by another number, right? So you take the profit of the business, okay, what it's making, and you divide it by $100,000, which is the value of your assets, okay? And you can see what kind of return you're getting. For example, if everything I described, all those assets, cost you $100,000, right? And every year your business produces $100,000 in profit, okay? You're making 100% return on assets. You're making its value every year, right? So you paid 100 grand for this stuff. It makes you 100 grand every year, right? So you have 100% annual return on assets, okay? So hopefully everyone understands the idea of return on assets, right? Okay. And this is, like I said, important in a situation where you're not selling the business or selling the entity, right? It could be an investment or a business or anything, we're trying to calculate a return on it. Okay. Now I want to try and keep up with my notes here because as stupid as they are, I'll get even more muddled if I completely abandon them. So let's see here. Depending on context, it's more precisely called ROA if the denominator is total assets. We already did that. Okay, so this version of return on investment essentially answers the question, am I getting a good return each year for the capital tied up in this business? And if you've never heard the term capital before, if you don't really know precisely what that word means, it means wealth. Okay, wealth. Wealth could be cash, but it could also be stuff, right? In this case, it's stuff. It's assets. Okay, so you have money tied up in this stuff, these assets, and it's producing a return every year. That's return on assets. So we already did a calculation, so I'll skip the calculation. It would be as if you had $10 million worth of assets, like a building and tooling and trucks, very important, Lamborghinis, right? That would cost you in the millions. And you make a net income, say, every year of 20 million, right? Or no, let's say 2 million. 2 million. It costs you 10 million, you make 2 million every year, so every year you make a 20% return on assets, okay? Now, let's do a slightly different example of this, just to make sure everybody's on the same page. Let's talk about a slightly different thing, okay, that enters the discussion in terms of return on investment. We've talked about return on investment itself. We've talked about return on assets. Let's look at another metric that goes even deeper called return on equity. Okay? We're going even deeper here. Now, think of your assets. Okay? Think of, in this example, it's a building full of equipment, office space, desks, and you have some intangible assets like a website. Okay? Website isn't like the same thing as something you can touch, right? It's something you paid for that exists, but it's more of a service than like a physical product, right? Same with like intellectual property, like patents and things. It's an asset. It's something you own, that you have, that you can put to work for you and make money, but it's not something you can really touch, really. It's the information, the knowledge that you own, an idea or something, right? So you can have tangible assets and intangible assets, but all of that stuff are assets that you own, okay? Now we've beat that horse to death. We already have talked about that, but let's go a step further. Your assets, like I mentioned briefly at the beginning, you can own them outright, in which case they're yours. They're bought and paid for, you own them, they belong to you, right? Okay? Or in order to buy them, you could have gone to the bank, and instead of spending your own money to buy them, you could have taken out a loan from the bank and used the loan money to buy the asset. In which case, who does the asset really belong to? Well, legally, officially, it belongs to you, as if you bought it with your own money. But in a sense, it also kind of belongs to the bank. Because let's say that you you took out a loan from the bank, you used it to buy this building or this asset, and you then proceeded to head for the hills, right? So you just took off, and you didn't pay any of the interest payments, to pay off your loan that you took from the bank. What would happen then? Well, the bank would probably repossess the asset. They'd take the asset because it probably was used as collateral in the loan. In which case, if you don't pay back the bank, they take your collateral, which is the asset, right? So in a sense, that asset it's owned by you officially, but not really, because you just borrowed money from the bank to buy it, right? Okay. So the point I'm trying to make is that an asset can be funded by you, in which case it's called equity, or it can be funded by a lender like a bank, in which case it's called, I got a weird thing in my head where I can't remember it. Debt. There we go. Thank you. I was just distracted by something I saw over there. It's very I'm going to have a word with people about that when it's done. Anyway, but so your asset can be financed by equity or debt, okay? And that's the idea. Now, let's pretend that you wanted to buy a company, okay? Like a company, something that's big and expensive. You can never hope to pay for something like that. It costs millions and millions, right? Okay? But what you can do maybe is you could walk into the local bank, okay, a commercial bank of some kind, and you say, listen, I want to buy that company, but I don't have the money for it, okay? But I have enough money to put down a down payment. Okay, is it okay if I put down 1%, 0.1%? And I'm going to borrow the rest from you, and I'm going to buy that company, and I'm going to use the company itself as collateral, right? So if I don't pay you back, that's fine. You own the company, okay? Now, I'm using this as kind of an example. It doesn't quite work like this in the real world, but hopefully you get the idea, right? Okay? So let's pretend that you did that. You put down a little bit of your own money, okay? You put down, I don't know, the price of a car or something, okay? And then you bought a multi-million-dollar big company, okay? And the way you did that is you borrowed the rest of the money, the balance of the money, by getting out a massive loan from a bank, okay? Now, what that would mean is that you have this company that you own. That means that you control, okay? Officially, you're the owner, right? That means you get to control. If you wanted to fire every single person in the company, close the place down, and burn it to the ground, you could, because it's yours, right? You still have to pay the bank back, but you could still do that if you wanted to, assuming you could pay the bank back, you're fine, right? So you have a situation here now where you've only put in a little bit of money, say 1% of the value of the company, but you control the entire company, right? So this is how somebody can control something without actually paying for it. Does that make sense? Okay, because the assets in that company are financed 99% through debt and 1% through equity. Okay, does that make sense? Is everybody with me so far? Okay, right. So now you've got a situation where if you're wanting to figure out the performance of this company that you own, right? What measurement do we use for this? Okay, because we know how much profit it makes. We know how much its assets are worth, okay? But there's a couple of different ways of looking at its performance. We've already covered return on assets. So we look at the amount of money that comes in divided by the total value of all the assets, which are maybe, I don't know, let's say $10 million, okay? I think that was the last example I used, something like that. $10 million, okay? But you didn't pay $10 million for it, okay? You put down the price of the car, let's say $50,000, right? Okay, so whoever's got a calculator and the ability to do arithmetic in their head, please let me know what's $50,000 divided by 10 million. Let me know in the chat, if you please. because that's your equity stake in the company, right? You put in $50,000, the bank put in the rest of it, the rest of the 10 million, and that equals the total value of the company, okay? So let's talk about return on equity. Okay, let's look at the calculation. So return on equity is, where is it here? Find my example here. Here we go. Okay. So no, that's not right. Did I actually write down that formula? No, I don't think I did I? Okay. Well, anyway, it's instead of looking at your income over dividing it by the total value of the assets, you divide it by the total value of the equity that you put in. Okay. In which case, it's $50,000 in our example, right? So we have a company that's worth $10 million. It's bringing in $2 million a year. Okay. So it's making 20% return on assets. Okay. But because we've only actually put in $50,000 of our own money to control this company with $10 million assets, what's the return on our money? We only put in $50,000. What is that entitling us to? Well, we now control something that makes $2 million a year. So our return on equity would be $2 million divided by 50,000. Okay. And Rishi says 0.005. Okay, excellent. So that's 0.5%. So we put in 0.5% equity stake. It's 99.5% financed through debt, right? Okay. So Rishi or anyone else, if you could do me a favor, calculate what's $2 million divided by 50,000. Okay. And that is your return on equity. Now that's going to be a big number, okay? Because you're going to take your money, you're going to be multiplying it many times. Okay. Now this is like a simplistic kind of scenario, right? But hopefully you get the idea, right? Now what we've done here is something called leverage. Hopefully everybody knows, hopefully you've heard that term before. If you haven't, it means that you've amplified something. And there's many types of leverage. There's operational leverage, there's marketing leverage, there's financial leverage. This is an example of financial leverage, okay? So what you're doing is you're only putting in $50,000 of your own money, but you're controlling something far bigger than that because of debt, because of borrowing, right? And we can see here, hopefully, the beginnings of why private equity companies, one of the first things they do when they acquire a target company, they leverage that thing right up. They take out so much debt, as much as they possibly can, really, and leverage up. So Rishi says 400. Okay, so your return on equity was 400, which is what, 40,000%, if I'm not mistaken. You know, that's a good return on your investment. You know what I'm saying? Now, in real life, it's a little bit different than this because, as you can appreciate, you will have other things that you have to cover. For example, the interest payments. So the $2 million that the company is making every year, you can't just take that money and put it into your pocket. You have to pay back your monthly payments to the lender that lends you 99.5% of the money to buy the company in the first place, right? So, you know, you'd have to subtract some things and then recalculate the ratio. But hopefully you get this idea. That's what leverage does. So, you know, if you're telling people, look, I'll take, you know, give me your money, I'll take it, I'll buy a company for you, I will give you a really good return on investment, right? You get a much greater return on investment if you buy the company with as little of that money as possible, use as much debt as possible, and instead of buying just that one company, because you're only putting down 0.5%, you buy several other companies too, right, with that money. And you, like, each one of those companies is like financed 99.5% through debt. You've taken out tons of loans to do this. They're all secured against the value of the companies that they've been used to buy, right? You know, so you're making like 40,000% returns in this example, you know, that's a good investment. So hopefully that makes sense. So, just to recap, we're talking about ROI, return on investment, which is an informal term. It's thrown around. It's used when you buy something, but then you sell it. And, like buying and selling, like, on eBay or whatever, the value goes up, right? So you buy something for cheap, you hold on to it, you sell it later, the price is higher. And the difference between those is your gain, right? Okay. So what's the calculation? It's your gain over the initial value, right? So if you made $20, that's your net gain. If you're buying something that cost you $100 in the first place, you made $20 on $100, you made a gain of 20%, right? We then talked about return on assets. That's more important when you buy something, but you don't sell it. You just hold on to it, right? And it makes you money as time passes, right? Okay. But that also is pretty limiting. None of these take into account the time scale, how quickly you make the money back, and none of them take into account, are you using your own money or you're borrowing money, right? And then finally, we talked about a third measurement called return on equity. And that takes into account at least whether you're using your own money or you're borrowing money to buy this thing, right? Still doesn't address the time factor. Now, I'm not here to teach accounting or anything or really math heavy stuff, but so I'm not going to get into all the calculations you would do in the real world that take into account, the time value of money and, the holding period and all this kind of stuff. But hopefully you get the idea. Okay. Now, do we have time or should we stop here? There's a lot more, but I don't know where to stop. What I'd like to do next time, I think, is what we're going to do is now that we've established that private equity firms in particular, they want to use as much debt as possible and as little equity as possible so that you maximize that metric, return on equity, right? You're making 40,000% returns on the money that you're putting in, right? Which means that you're not using very much of your own money, which means you can buy many companies and do this on a big scale, right? We've established that they like debt, they like leverage, okay? Next time we're going to look at what are some of the limits in the real world, like in a practical sense, of how much leverage you can use. Because as Rishi rightly pointed out in the chat, high leverage is very risky, right? You're open to all kinds of risk. If you're if the business has a bad month, you're screwed because your monthly income goes down, and then now you can't cover your interest payments to the bank. So you go bankrupt, and then they take your company, right? So there's some real things that are pushing back against just financing the whole thing through debt, right? So we're going to cover those next time. And we're going to see where this leads us, like why, once we know some of the factors pushing back, what are private equity firms trying to do based on knowing what they're trying to push against, okay? And then we can understand what we see them doing in the real world, okay? So that's what we're going to cover next time. Daily live timings. What does that mean? Maybe that's a bit out of context. I can't remember what I was saying when you responded to that. But that's probably good for today. I want to thank everybody who's here. There's 17 people here. Thank you to Bear Razor, who participated. Thank you to Rishi, who not only participated, but did some calculations for me. Because it's hard to do math when you're live in a live stream and you feel like the world is watching. It's like sitting at a table with 12 people staring back at you. It's hard to think highly original, deep thoughts in such a situation. I'll be back same time next week with another edition of Private Equity Rundown. We're going to continue this discussion, and I will be back in just less than half an hour on this channel talking about job search, talking about some of the practical issues with job search and how it's conducted today. If you are looking for a job, what are some of the practical issues? Not the theory behind what should happen, but what actually does happen. Okay, so that's going to be in half an hour on this channel. I do a live stream called, what the hell is it called? Honest HR Nitrous. And so that's an interactive Q&A about that stuff. Have a good weekend. I will see you guys next week, same time. Let me know if you have suggestions for topics. Check out this course, okay? This one right here, the $100 MBA, best bang for the buck around if you're trying to learn business, okay? What this will do for you. First of all, if you're an entrepreneur, this is a no-brainer. You learn all the business theory, and business, of course, is the scientific study of how to make money. So it's a pretty useful thing. If you are not really an entrepreneur, you're someone that maybe is thinking of doing a side hustle, that's still useful, okay? You can get this course. It's super flexible. You can go as deep as you want or as shallow as you want. Just skim everything. That's all you want to do. And you can do it entirely on your own schedule, entirely on your own terms. So check that out. There's a lot of information about the course, so it's very transparent. I guess that's it. I will see you guys soon. Take care.